Hello, everybody. My name is Andrew Dix. I am the founder and CEO of the Crowdfund Media Group, and we are publishers of Crowdfund Insider. This is a digital news site that covers the full stack of fintech, including online capital formation and crowdfunding. We also cover, we try to cover what's going on in Canada, which has emerged as a small but pretty robust ecosystem in regards to both fintech and crowdfunding. And today I'd like to thank the NCFA, the National Crowdfunding and Fintech Association, for hosting this event. And we are going to be discussing the state of regulated crowdfunding in 2020. And this is coming from a perspective of both Canada and the US. As we're going to get into, there's a good amount of back and forth cross-border capital raising, and we have some experts that have joined us to explain everything, because these guys know everything, and I'm here just to help to facilitate. So I'm going to start by introducing our panel. First up, we have Youngro Lee. He is the CEO and founder of NextSeed. Now, NextSeed is a broker-dealer that operates in the securities crowdfunding sector. They're what I would call a full-stack platform. They do not only Reg CF, Reg D, and Reg A+, which I'm not going to explain right now, but they also are evolving and doing a lot more in the digital investment sector, which is kind of cool. NextSeed started as a bank replacement platform, but has since kind of diversified into doing real estate and other early stage financing. And Youngro is also the president or the chairman of the Association of Online Investment Platforms, which is a group of platform leaders seeking to engage with policymakers and regulators to help create a robust ecosystem in regards to online capital formation in the United States. And he's also participates in the SEC Small Business Committee, which helps to guide this policy transition. So, Youngro, thank you for joining us. Next, we have Woody Sherwood Neiss. This is one of the godfathers of crowdfunding in the United States, and seriously, he was there at the beginning. I have the photographs of him at the White House to prove it. The Jobs Act of 2012 was enacted into law in 2012, obviously, and he was one of the co-authors of this profound legislation that legalized crowdfunding. And when I say crowdfunding, I mean the all 3 exemptions that facilitate online capital formation. His focus has largely been on Reg CF, but of course he understands everything. The organization that he represents, Crowdfund Capital Advisors, is also does data tracking for Reg CF. He probably knows more about the Reg CF ecosystem than anybody I know. So thank you for joining us, Woody.
Yeah, it's great to be here. Thanks. Excellent.
And then we have Alixe Cormick. She's the founder of a venture law firm based in Vancouver. I've known Alixe for a number of years now, and she is the one person in all of Canada that I can go to, and she can immediately explain to me anything that's going on in regards to crowdfunding, securities law, raising capital. So she's been really a go-to source for our publication, and she's kind of in the thick of things in Canada. Her law firm works with issuers to raise capital within the various exemptions that exist in Canada, but she also does more traditional capital raises, and she also is probably one of the few people who understands how to do a cross-border capital raise, so a Canadian issuer raising capital in the United States as well. So she has a unique qualification in regards to her professional expertise. So thank you for joining us here today, Alixe. So first off, I want to start with you, Alixe, and ask the question, what is the state of regulated crowdfunding in Canada today?
In Canada, we have a different system where it's a province by province securities regulator, and each of the provinces can either adopt multilateral instruments, individual instruments, or we do have national instruments that apply right across Canada. When crowdfunding was adopted in Canada, we adopted two different versions, one that was essentially led by Ontario and Alberta, and a second that was led by Saskatchewan and British Columbia. Saskatchewan initiated the crowdfunding movement here in Canada, which I'd like to thank and give them a shout out for. And the one crowdfunding exemption allowed you to raise a little bit over $1 million. However, it's not been used at all in Canada. The second crowdfunding exemption we call the startup crowdfunding exemption, which was adopted in British Columbia, Alberta, Saskatchewan, New Brunswick, Nova Scotia, and Quebec, and that particular exemption has seen some use. We have a total of 12 portals, but out of those portals, only 8 are active on the startup crowdfunding exemption, and they've raised a modest amount. We also have kind of other types of crowdfunding portals that do accredited investors only, and they're split into debt, real estate, and just everything else. We have one portal that also relies on the offering memorandums. The other types of portals are required to be exempt market dealers. In other words, they're much like Youngro's, a full stack dealership, which can offer pretty much anything and everything. Those portals have had, again, a modest amount of use, but not the type of use that we've seen in other jurisdictions. Currently, right now, the securities regulators are looking at adopting a national instrument for the startup crowdfunding exemption, where they would take the existing amounts that are allowed to be raised, which currently is $500,000 in a calendar year, split into 2 separate financings of $250,000 each, where investors are only allowed to invest up to $1,500, and increasing the amount that can be raised by issuers to $1 million, reduce or eliminating kind of how much they can raise in any one offering and just make it a yearly cap, and then increasing the investor amount to $2,500. That instrument is out for review and comments are being taken until July 23rd of this year.
All right, well, let's migrate to the United States. Thank you, Alex. And we're going to start with Woody. Can you provide an update as to the U.S. ecosystem for crowdfunding? I guess start with Reg CF, since you're an expert on that, and then maybe if you could mention Reg A Plus and Reg D 506C.
Okay. So regulation crowdfunding is only 4 years old. It started in May 2016, but I think it's made some tremendous strides, and it's really proved the naysayers wrong. Since it started, there's been about 2,700 companies or issuances across the United States, except for North Dakota. That's the only state where we have not seen one. Issuers have sought about $1.7 billion, proving that there's demand among these issuers for capital from investors. They've raised about $381 million to date collectively. The average raise for an issuer is about $250,000. So when you're looking at the valley of death, which usually starts at about $25,000 and ends at $250,000, this really solves for that problem right there, because it allows you to use your personal capital in the beginning, use crowdfunding in the middle, and then you can go on to more institutional type of financing, be it bank or VCs, after you raise your money from your crowd. The success rate for a regulation crowdfunding offering hovers around 60%. I think that's a huge success, because if you try and go to a VC, it's about 2% success rate. Banks don't always give loans. You have to have 3 years of operating history, so you usually are disqualified right out of the gate. Them, if you're a startup or small business that hasn't been around long enough. Interestingly enough, within the data, there's 100 issuances that have raised over $1 million. So it proves that you have the ability to raise a significant amount of capital from the crowd. There's been over 575,000 retail and accredited investors that are backing these companies and these offerings. I think that speaks tremendously to the interest. In the beginning, people were saying, this is the domain of angels and VCs. And what we're seeing is no, that's actually false. Any small business or any startup or any Main Street business can go to their customer, their families, their friends, people that know them, have been in these businesses and seen them, and become investors in these businesses. And that seems to be working, and it's true. These companies that are doing these offerings online have supported about 75,000 direct and indirect jobs. So clearly this is a jobs engine, which is really important for these local economies, because when you employ people, they start spending money in these local communities, and that circulates in the communities about 6 times. So anything that we can do to help these local communities access capital will only benefit not only the local communities, but the whole macro economy of the United States as a whole. If you look at the data in terms of which states are leading, it's very similar to what we see in the public markets. Companies that are based in California, New York, Texas, Massachusetts, and Florida lead in both the number of issuers and the number of capital that's been committed. What I love to point out, and I kept on saying this in hearings at the SEC in front of Congress, is that it's going to be very hard for people to pull the wool over thousands of investors' eyes. And it turns out 4 years later, actually, when the SEC was writing a report on the first 3 years of Reg CF, they found that there was no fraud within the industry. So I'll repeat that, there's no fraud. And I think that's one of the reasons why we're seeing traction pick up. If we just dig into the data a little, we can see that month to month, things are progressing rapidly right now. This month in July looks like we're on target to have the highest month of commitments in the history of Reg CF. So it'll probably end up to be close to 20 million. If you add up the last 3 months, that's about 53 million in commitments. And to put that into perspective, in the first year of Reg CF, which is only really 3 years ago, at the end of that first year, there were a total of $39 million for that entire first year. So if we have 53 million in the last 3 months, I think you can see that the traction's really starting to pick up.
Okay, and I want to get back to that point a little bit later. And you made a couple very important points about how this money is dispersed. So a company raises it and then they spend it. It's not sitting inside, and that's a huge economic multiplier. And I think that's a very important policy item. Now, what about the other 2 exemptions, Reg A plus, Reg D, 506C?
So when you're looking at Reg A, there's Reg A allows issuers, just for people that don't know, to raise up to 50 million from retail and accredited investors here in the United States. There's 2 tiers to it. Tier 1 hasn't been used that much, only because you have to have essentially state review of the offering, and so people finds it very bureaucratic and cumbersome and costly. So tier 2 is where most people are focusing the raises. Under tier 2, if you look at the 2018 data, which is the latest one to come out of the SEC, issuers have raised up to 675 million. In 506C offerings, which is an online accredited offering, only for accredited offerings, that's raised about 211 billion. So it's a widely used exemption there. And a 506B, which is an unlimited amount of accredited investors. You can have up to 35 unaccredited investors, but there's 0 solicitation allowed, so you can't publicly post this. That's raised about 1.5 billion. So the ones that are closed behind doors have been around a lot longer, except for the 506C, that's sort of new, but it did open it up to online investment for accredited investors. Those segments are much more mature typically, and they raise a lot more money. But I think, they've been around longer, so Reg CF is going to be catching up.
And I want to add there, because you're an expert in Reg CF, and you mentioned Reg D, 506C. We are seeing platforms that will do side-by-side offerings, and that is kind of a workaround to go beyond the 1.07 million cap right now, correct?
Yes, it's very true. I think, it was interesting to see how the platforms were thinking, okay, how can we allow issuers to come onto the platform, but not be limited by the caps that have been put in the legislation? So these parallel offerings, I think, are a great way for them to actually benefit both sides. Accredited investors can get in, they're not restricted, and the retail side can get in, and we're also protecting them from risking more capital than they can afford to lose.
Okay, excellent. So in the United States, an accredited investor is an individual that earns over $200,000 a year. If you're married, $300,000 a year, or you have $1 million in net assets outside of your primary residence. That's the current definition. So now I want to migrate over to Youngro, because he operates a platform. And he's also, not only the chairman of the Association of Online Investment Platforms, but he's deeply engaged with the U.S. Securities and Exchange Commission because they're going through what's called an exempt offering ecosystem review right now. And we anticipate that they're going to make some changes that will impact online capital formation crowdfunding in the United States. So, Youngro, what are your thoughts on this right now?
Yeah, no, I think to start, one thing that I want to highlight, both Canada and US, and I think the difference is clear in US, a lot of people assume that when a law is passed, that means change is going to happen. And that's just not true. And that's unfortunately the reality of regulators and legislators, coming up with laws in a vacuum by, let's say, academia or more of a theoretical context versus what actually happens in real life. I would say virtually 100% of the reason why there's been much more growth in the U.S. versus Canada, despite what at least theoretically seems like similar rules, is the platforms. Like each of the platforms themselves are startups, right? Like they're and it's the platforms that we're associated with through the association, as well as every other platform that we've seen. They're amazing. Like the entrepreneurs or founders, some of them do have their own VC backing, but a lot of them are basically doing it through their own personal just resources. And that, I think, has been the amazing kind of spirit, let's say, in the US, of the platforms themselves, being really creative, coming up with these solutions. And candidly, I think that has been respected by the SEC in US, right? Like they made rules and they saw that the platforms are acting with good intent, are really coming up with creative solutions that even they didn't think of. Just because I know my platform, like we, for example, utilize a platform to do debt financing for small businesses, which was literally not what the rules had in mind, because as you know, even in the media, they always called it equity crowdfunding as if that's what it was for. No, but it's not. It's a securities crowdfunding that can be applied to use against any securities. So kind of fast forward to the last 3 years, or fast forward the last 3 years, 4 years to get to today after the rules were implemented in 2016. The SEC has, I would say, been very proactive, I would say. Obviously this is a regulated world, so it's everything is slow, but the SEC has a new division called Small Business Advocate that really focuses on helping small businesses and startups. And so they've been engaging with the industry, including inviting myself to serve on the advisory committee that's been able to give a direct feedback loop to the commission on the effectiveness of these rules. So not to kind of get too technical, but generally speaking, there are potential changes about increasing the amount of capital that can be raised under regulation crowdfunding from $1 million to something higher. People are thinking 5, some people are wanting 10. I don't know, but I think it will be something higher than $1 million. There also talks about increasing the investment limits, because that's another big issue in regulation crowdfunding. For example, accredited investors, even if you're accredited and can invest unlimited amounts in Regulation D or Reg A, and Reg CF, for some reason you're capped, and so that caused some adverse impact. And I think there's different types of technical aspects that are being changed. There's a feedback period in the SEC that people can comment. They're still accepting comments, even though I think the official period is over. But I think the takeaway is SEC is a partner, right? It's not sometimes people think of SEC as like a police agency for the financial industry, which in some ways they have to be. But in this space, I would say they have been very favorable, relatively speaking, to the idea that this is the foundation of entrepreneurship. We need to help small businesses, and this need has been especially big over the last few months due to COVID. And you can see that by SEC having announced a temporary relief on certain provisions of regulation crowdfunding, which, as far as I know, is very rare, if ever, SEC has done on kind of the rules. So it's good. I think we hope that these positive rule changes will be done in a thoughtful way, and we as an agency, as well as the advisory committee to the agency, as well as the industry, is trying to provide that good data. I know Woody does a lot of work in this area that's been creating let's just say, an impression of a responsible industry that I think is helpful for everyone.
Excellent. And I'd like to give kudos to Youngro, because he's been a key voice interacting with the Securities Exchange Commission to explain what's going on, because he has boots on the ground experience. He's managing issuers and investors as well as the platform, and I think he's been a vital variable for potential change going forward. And I agree with you that the current commission has been pretty forward-thinking as to how they can improve the ecosystem for smaller firms to raise capital, which is fantastic. And I know the current chairman, Jay Clayton, has publicly stated he expects to have updates on these rules before the end of the fiscal year. Of course, we don't know exactly what they are, but I remain optimistic. I'm optimistic we're going to see some positive changes here. So, thank you, Youngro, for all you've done for the industry. This is very important stuff. I really appreciate your work. So now let's switch over to cross-border crowdfunding. And I want to go back to Alixe here because, again, she's the one person who I can go to and ask questions to understand, what's going on, how it operates, what are the dynamics here. And she's actually worked with, multiple issuers that have sought to raise capital not only in Canada, but the United States. So Alixe, what is going on for an issuer? How are they doing this if they want to raise capital in both Canada and the United States?
Well, as you know, Andrew, there's a number of different exemptions that are available in the United States that's available to anyone raising capital, regardless of where they are in the world. The crowdfunding exemptions tend to be more restrictive. So the regulation in CF that Youngro and Woody have talked about earlier is really only available to U.S. Incorporated companies or operated businesses, and there's a number of other criteria there. Regulation A+, which Canadians have used as kind of a crowdfunding way of raising capital, is available to both Canadians and U.S. issuers. And also people have used the accredited investor exemption in the United States to raise capital on different platforms. So Canadians, we're a very small population in comparison to the United States. We're about 35, 36 million people, depending on who you talk to. And we're located within 100 miles of a border. Almost 95% of our population is close to the border or an hour drive to the border. And so as a result, we have a great affinity to the United States, maybe not right now during COVID as our borders are closed, but traditionally Canadians have raised capital down in the United States, particularly tech, biotech, mining, and other types of industries that require larger pools of capital. I always tell people to go where the love is, and certainly tech and biotech have always received more love in the United States than they have at home. And so that's been a kind of a traditional place for myself in terms of my practice, and the majority of my clients are raising capital down there. Regulation A has only been used by a small handful of issuers. 11 have qualified, 20 have applied to date. That I am aware personally of at least 6 more companies that want to do a Reg A offering from Canada this year. Of the companies that have used Reg A to raise capital in the United States, 5 of them have successfully raised about $44 million. Not a huge bucket of money, but about $8 million per project sort of thing of capital that they've brought back home to kind of utilize in their business. This year to date, about 246 Canadian issuers have filed Form Ds indicating that they've used the accredited investor exemption in the United States to raise capital. Some of that will be on platforms. Most of it's kind of traditional find a accredited investor through an angel group, through a venture group, or through contacts that you personally have. CF crowdfunding has not been successful for the companies. A lot of Canadian companies will incorporate themselves as a Delaware, Nevada, or Florida company, some Wyoming, and they will then use other exemptions that are only available to domestic issuers like Reg CF. There's been about 6 companies that have attempted that. I'm not aware of any of them really successfully raising all of the funds that they were looking for. As Youngro alluded to earlier, platform, kind of who is running the platform, but also the people raising capital. There's a lot of work in raising capital. And so when you're using a crowdfunding portal, whether it's in Canada and the United States, you really need to kind of utilize all of kind of the tools necessary to be successful. And that's a lot of marketing, that's targeting, kind of knowing who your audience is, and also kind of before you even start figuring out where you're going to end up.
Okay, so we are seeing a little bit. I've seen a couple issuers on a couple different platforms that were, Canada-based for all intents and purposes. Youngro, what's your experience been with any cross-border offerings?
Yeah, I mean, at least I can't speak too much about what's happening in Canada, but I have seen some international-based, or what appears to be some international-based companies utilizing U.S. crowdfunding rules, including Canada. And the one key thing that I want to highlight to all the issuers or advisors or platforms in Canada that's trying to help Canadian companies raise capital is it's actually not just about the U.S. rules. So the U.S. rules say whatever it says, but the other aspect of that is the U.S. banking system, and both for the companies as well as the investors trying to invest. So in short, regulatory crowdfunding requires any such offering to be held in an escrow account by a U.S. Institution that's legally allowed to do that. So that's basically another bank or a clearing broker dealer or something of that sort. And again, every platform basically has their own back end. So every platform is, again, subject to their own partners' rules on who can raise capital, because some firms will not list a deal, even if they have a U.S. company, if they think it's a shell company, or if they think the owners are, committing fraud, or, for good or bad reasons, right? So there's basically a lot of different variables there. So the key takeaway is, if you are a Canadian company or an advisor to a Canadian company trying to help them use U.S. rules, you basically have to, ask the different platform operators, like, what are their requirements, not just the legal side, but the practical banking side. And it kind of, to make a very broad statement, it probably helps if you have some presence in U.S., even if you're a Canadian company, like even if it's an office, even if it's, one of the ownership, whether shareholders or the officers are a U.S. person, as an officer or green card or whatever. But the more, I think, presence you can show in the U.S., the easier time you will have. And that's just the banking side. On the actual fundraising side, as Alex said, like, it's not free money. Just because you launch the campaign doesn't mean you're going to get funded. And Woody cited 60%, but I think that's probably 60% of a successful deal, but not all 60% may raise 100% of their capital goals of the campaign. So again, there's a lot of variables that goes into a successful offering, and you're going to need to commit, I would say, a significant amount of resources as a non-U.S. company to utilize U.S. rules. But it can be done if you have the resources, at least the basic resources and preparation and mindset and commitment to do that.
Okay, excellent. So it's a lot of work. You got to adhere to the rules in both countries, but it can be done. I think that's kind of the takeaway there. I'm going to jump over to Woody right now. So you're the data guy. You know everything that's going on in Reg CF before the SEC does, probably. So what types of firms are you seeing, or have you seen, that are utilizing Reg CF in the past and today? I think that when the original law was written, there was a lot of discussion about kind of Main Street issuers or very small firms, but I also think that we've seen a more diverse group of issuers utilize Reg CF. So what are you seeing? Give me the facts.
Yeah, I mean, I think you hit the nail on the head. When this was going through Congress, there were a lot of discussions by naysayers saying, well, adverse selection is just going to drive bad companies over to the online funding space, and that's not going to be good for investors. But that couldn't be farther from the truth. If you look at the companies that are raising money, and by the way, let me just couch this in perspective too. Their argument was, this is the domain of angels and VCs and private equity. But the reality is, angels, VCs, private equity only fund a small percent of the business. They only fund businesses that are in proximity to their offices. And they're looking to deploy very large number of checks, and smaller, fewer of those checks than the crowd is. The crowd does not share the same opinion on this at all. The data shows that the crowd has backed over 450 unique industries in the United States. So that shows there's a broad application among the industries in the United States the crowd's interested in funding. They're backing entrepreneurs in their own backyard. So you don't have to be in Silicon Valley, in New York City, and Boston in order to get the capital. And I don't think you should fight against these companies that are outside of these capital intensive areas and deny them the ability to raise money from people that want to back them. The reality is the way this works is you've got the crowd coming in with smaller checks, but in a much greater volume than VCs. If you look at the median number of investors that back one of these companies and campaigns, it's about 185, and that looks at all the offerings across the entire industry. And their average check size is about $900, so it's much smaller than a VC check would be. What's really fascinating, though, is, people were talking about, is it just going to be startups with zero revenue? That makes up only 19% of the companies that are raising money online. A vast majority, 71% of the companies are less than 3 years old. So what I want to point out there is, in the beginning, I was telling you, if you try to go to a bank and you have less than 3 years of operating history, it's going to be almost impossible for you to get any type of financing from them. But that's not the case with the crowd. As a matter of fact, 64% of all the capital that's been committed has gone to these companies that were less than 3 years old. So I think it shows that there's power in this sort of area that we created for these companies to raise money. The reality is, if you look at the companies that are older than 3 years old, they're raising significant capital as well. About $139 million has been raised by companies that are more than 3 years old. So why am I pointing that out? Well, because if you're older than 3 years old, you should qualify for more traditional type of financing. So why would you even need to go to the crowd? Well, clearly there's benefits that come from the crowd in terms of capital, but marketing power, connections, networking. They have ideas on how you can help grow and scale your business that you might not get from a bank loan, or a VC might have other portfolio companies and not give you the attention that you're looking for. A couple other things that I just want to point out quickly on this is, earlier I was talking about the 450 unique industries that are represented, but let me just tell you what some of the top ones are. The top by capital and number of campaigns is what we call diversified media. So think about your film and your entertainment, music and sports. There's a lot of companies that fall in that sort of area. It's very difficult for them to get sort of VC type of financing. But if you got a passionate group of fans or customers, they are willing to put capital into these businesses. That's what the data is showing. Interestingly enough, restaurants, second most popular thing. Youngro has done a phenomenal job with his platform in terms of helping restaurants, and I think with an insanely high success rate, almost 100%, if I'm correct, Youngro. Wow. On helping them get capital that they need. And restaurants, again, are typically hard to fund type of enterprise. But when you've got people that are passionate about the food in a restaurant, or want that restaurant to succeed, and I think we can talk about this later on in the post-COVID world, you want the restaurant to stay where it is. So these customers are becoming investors in these restaurants. Interestingly, and the next thing is, we like to drink. So wineries and distilleries, breweries are really popular because, again, they've got this engaged fan base that want to see these businesses succeed. After that, there's household and personal products. So if you got your local gym or something. And then, interestingly enough, and I'll end with this, is software application is after that. So you would have thought when this kicked off that, oh, this is going to be those software companies that are in Silicon Valley that don't get financing from, the VCs there. The reality is, you've got software companies that are coming out of universities all across the country, and they've got people that want to back it, and you don't have to be in Silicon Valley anymore. So it's, you've got the broad spectrum. We've got a lot of Main Street bricks and mortar types of businesses, but we've got a lot of businesses that have the potential for one of these exits or an IPO, I think.
All right, that's good to know. So let's go back across the border and head north with Alixe. You've worked with a lot of different issuers. What makes an effective offering in Canada? Is it more of the same?
Again, I think whether you're using a portal or you're doing kind of a traditional kind of accredited investor round or something like that, you need three fundamentals. People need all three fundamentals before they're going to invest. One, they need to know you and your team and like them and believe in your abilities. They need to know and understand your business, and they need to know the investment opportunity against all other investment opportunities that they have an opportunity to invest in. So really, an online portal and a crowd, whether you're doing crowdfunding or accredited investor, allows you to kind of get through some of those hurdles a little bit better, because you can post materials all in one place and point people where to go to see those materials, to learn more about you. You can post videos, which provides an eye-to-eye connection, particularly in the times of COVID when you can't do a road show or meet people in person. person. So it allows people to get a familiarity about you. So you're kind of getting over the first hurdle is they know you and they know your team and your capabilities, and that needs to be conveyed in some way. And then knowing the business. And then you can also convey that a little bit more going through, but there has to be a natural interest of that investor to kind of want to learn more about your particular business. They may know you, but they may not know that particular business sector and just say, I don't invest in that sector. I don't know anything about it. Most people think that they know real estate, they know alcohol, they know restaurants, and they know, software applications that appeal to them, and particularly depending on kind of their economic value. The other is the investment opportunity that you're offering. And so people oftentimes think you post it and people will come. Well, they're not looking for you, and they have other places that they can put their money. So you need to show them why your particular opportunity is going to be the best place to put their money to work.
So unfortunately, we are out of time, but I would like to thank NCFA as well as Toronto Finance International for putting on this excellent event. And I'd also like to thank all of our panelists. Thank you for all participating and sharing your wisdom and knowledge for this panel. And if there are any attendees that have any questions for our panelists, please put them in the chat box that's on your screen, and we will be happy to answer them. So thank you very much.